Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class was never out of session because the learning never stops. So today we're going to talk about a subject that kind of comes up jokingly. It's every 4 years. I always hear about these famous people who always say, if so-and-so becomes president, I'm going to lead the country. And I've seen it on both sides. I've seen Republicans do it and I've seen Democrats do it. Obviously we hear it a lot from Hollywood people, but I've actually talked to some people who are pretty well off, who basically say if so-and-so becomes the president of this country again or the first time, I don't want to be part of this country anymore. Now, where this really becomes a very serious topic is where I have clients who come to me and say, Kevin, I've been an expat for the past 25 years, been living overseas for the past 25 years, and I don't want to live here anymore. I don't want to live in the United States anymore. I'm just going to give up my citizenship. I'm going to go ahead. I'm already a citizen of the country where I'm living in. If I give up my U.S. citizenship, it'll just transfer everything over, and that'll make everything nice and clean for me. And I just don't have to do these tax returns anymore. What you're going to realize is that there are certain people that this is going to affect much more than others, okay? And we'll go over these rules, but one of the reasons why we like talking about this here at Beta Solutions is I pride myself on being an expert in international tax. There's probably only about 3% of CPAs who feel comfortable in this area. I'm one of them, okay? So I get these questions a lot, not only from my clients, but I also get these questions a lot from other people in other firms that are coming to me and saying, Kevin, I don't understand this stuff. This stuff makes no sense to me. And so I was just sitting here thinking, gosh, if I could really shoot a quick video on this, I think it would actually work out well for some people. Again, the purpose of this video is not for you to know exactly what's best in your circumstance, but to give you the questions that you should be asking your tax professional, okay? And if your tax professional doesn't understand these questions, you need to find somebody who does. Again, there's only about 3% of us who feel comfortable in this area. Find one of those 3% that you can work with that will actually help you be very successful in this area, because the last thing you want to do is cause yourself a lot more pain than it's necessary. And so when we're talking about giving up your U.S. citizenship, first of all, psychological effects aside, there's huge tax implications, okay? Basically what ends up happening is you have to have you have to be a covered expatriate. And a covered expatriate is a U.S. citizen who relinquishes their citizenship, or any long-term U.S. resident who ceases to be a lawful permanent resident of the United States who meets one of the following tests. All right. Now, the long-term permanent resident means, it means you got a green card. Okay, so if you get a green card and you come to the United States, and just to let you know, a green card, I know they're not, I don't think they're green anymore. At least I haven't, the last couple that I've seen weren't green. I think they were kind of pinkish, yellowish. Back in the good old days, and I'm talking like the 1980s, I remember when I was a kid and I saw one of my friends who was a green card holder, and she showed me her green card, and it literally was green. I mean, that's why they called them green cards at the time, and that term's just kind of stuck. But if you meet one of the following tests, and there's actually going to be 3 of them, okay? So there's if you meet one of the following tests, and there's going to be 3 of them. The first test is that your individual annual net income tax for the periods of the past 5 years ending before the date of the U.S. citizenship or residency lost is greater than the inflation-adjusted amount that is $165,000 for 2018. All right, so if you take your last 5 years for the past 5 years, and your average is more than $165,000, you're going to be one of these covered expats. 2, your net worth as an individual is, on the date that it is lost, is $2 million or more. That is actually not an inflation-adjusted number. That's been $2 million for a long time. So I'm anticipating one of the 2 things is going to happen. Either eventually they're going to have changes make it inflation-adjusted, or they're going to leave it at that, and sooner or later, more people are going to get hit by that than they're going to get hit by the other tests. I will tell you, I don't see anybody in Congress having any desire to change any of this because, quite frankly, it doesn't affect very many people, and there's probably a little bit of a stigma, that, oh, you want to leave the United States? I'm not worried about you, and which is unfortunate because I think we ought to treat people well anyways, but that's neither here nor there. Test 3, the individual fails to certify under penalty of perjury that he or she has met the requirements of the tax code for the preceding 5 years, or fails to submit evidence of their compliance with IRS tax returns. That third one kills a lot of people. Okay, and I mean kills figuratively, not literally. It hurts a lot of people because there are some people, what happens is they go and they become expats, they go and they leave the United States. They're not on the books anymore. All right, obviously they still exist, they're still citizens, but the IRS doesn't get any W-2 information from those individuals, so they don't know that they're actually earning any income. So the IRS doesn't send out notices looking for their tax returns. And so these people come under the mistaken idea that they don't have to file tax returns, which is false. If you're making income overseas, you are taxable on your worldwide income regardless of where you live. Now, there's a few things that we can do in order to remove those taxes. There's the thing that we call the foreign earned income exclusion, but then we also have the foreign tax credit, and those two things can reduce your federal liability, but that doesn't mean that you don't file tax returns. You still have to file. And so if you can't certify that for the past 5 years that you filed your tax returns, you're going to get hit by this. Now, it's also easily fixable. We go ahead and we file your tax returns for the past 5 years. And that usually helps alleviate some of that. Now, again, this kind of gets, and forgive me for getting on my soapbox for a few minutes, but this is kind of something that I find important. I do want to make sure that everybody is under the impressions that they should be filing their tax returns, okay? And if you haven't been filing your tax returns because you're an expat living overseas, please reach out to us. We'll be very happy to help you out. I get this kind of call all the time. We do package deals so that you're not paying full price for each tax return because it's ridiculous. If we're doing 3 years worth, usually we can bang them out just like that. So we do a package deal and then it goes on. So again, if you have that situation, go to my website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. So all the property of a covered expatriate is treated as sold on the day before the expiration date for its fair market value. Now, where we start seeing that as a problem is because what ends up happening is people might have moved overseas and they don't realize that when they're saying that everything that they own, we mean everything that you own. Okay, that doesn't mean everything in the United States. That means everything that you own, period. Okay, so if you own a house over in in whatever country it is that you're in, you are still going to be subject to the taxation on that, because what's going to end up happening is the IRS is basically going to say it's still an asset owned by you. You're still a worldwide citizen. I mean, you're still a U.S. citizen at that time, worldwide income. Okay, now, what will end up happening is that it has to be calculated and figured out as to how much tax that you're going to end up owing as a result of this. And that's not an easy factor to do, okay? Now, the good news about this is that if after 2 or 3 years you decide you want to come back, you will have received step-up basis as a result of the taxes you've already paid. Okay, so it's not like you make this tax and this is like a penalty tax for leaving the country, but then later on you end up coming back and you get absolutely no benefits for the taxes that you paid before. That's not the case. I have actually had one client who did that. They had left the United States. They had been gone. Actually, this person had been gone 15 years. This is before that the expat tax had come back. But the question of the day was when they had come back, they had paid some tax on some stuff that they had sold in the past, but then reacquired. Do they still get the basis and all that sort of stuff? It was kind of an interesting circumstance as a result of that. But again, it's something that we can definitely examine and make sure that it ends up getting taken care of. All right. A covered expatriate may make an election to defer the payment of tax attributable to any property that is deemed sold under the mark-to-market rule. A tax deferred under these circumstances bears interest for the due date, and then is only permitted only if they provide adequate security. I've never tried to do this. And to be honest, I've only done this where we've actually had to calculate this on probably about 3 or 4 individuals. Yeah, four. There were 4 individuals we had to calculate this for, and it's not a, first of all, it's not an easy thing to do. By the time we got done figuring out what the tax was, I just said, "Do you have the money?" And they're like, "Yeah, I do," and I just want to pay it and get done, and they just did. And it wasn't a big deal. But obviously it's a big deal. Say, for example, you find out that you have $1 million worth of taxable income. Obviously, you may need some time to pay some of that stuff off as you're leaving. Although I think at that point, most clients are probably going to be like, I'll just go ahead and stay an American citizen. I'm not paying any tax anyways because I'm living over here and I'm not making any money anyways, blah, blah, blah. And so it's not a big deal for them. Another area where this can become problematic, and especially if you're a green card holder who came here to the United States and got the green card because and this is what happens oftentimes. Employers will come to you and say, "You know what, we want you to go get the green card." And the reason why they want you to go get the green card is they're sick and tired of paying for your visas, And if you just go get the green card, everything's great and wonderful. And of course, no employee wants to make their employer unhappy. So they're going to be like, "Oh yeah, I'll go get the green card. It'll save you a ton of money. It'll make things easy on me because I don't have to file for this visa all the time." Life's great and wonderful, but what they don't understand is that sometimes they trip themselves up into the fact that they become liable for this tax without knowing it. And that's when you want to make sure that you're talking to a CPA who understands what's going on to see if this is actually best for you. Now, another area where this comes out, especially for those who become green card holders, is the deferred compensation. So, for example, you come here to the United States and you're working under a deferred compensation agreement, and say you're coming from Germany, and you come here to the United States, and you're working under a deferred compensation agreement where if you work for the company for 7 years, you'll get this huge incentive package. During those 7 years, you come to the United States and you work for 3 years. You didn't know you were going to work here for 3 years. You thought you were going to work here for the rest of your life, so you go ahead and get the green card. Okay, or you applied for the lottery, got the green card, and then the company sent you over here, but then wanted you to go back. Okay, the IRS is still going to expect that you still have a tax liability on that deferred compensation because it's sourced here to the United States. Okay, and income sourcing rules are not fun to deal with. Okay, if you have any questions about deferred compensation income sourcing rules, you need to reach out to us, or you need to reach out to another CPA who understands this stuff. Okay, because you can actually be taxable in the United States on deferred compensation as a result of this. And if you are leaving, deferred compensation is subject to that 30% withholding. Okay, so it kind of gets to that point where if they can prove how much is sourced to the United States, the employer has the requirement to withhold the 30%. If they don't withhold the 30% that's necessary, they're liable. So they're going to get their books right on this one. Okay, so you probably want to make sure that you get your books right on this also. But furthermore, you leave back to Germany, and you think your tax obligations to the United States are completely done because you don't have your green card anymore, you gave up everything, blah, 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 so on and so forth. Well, guess what? Now you still have to file a non-resident tax return when you receive that compensation because now compensation is taxable to you, and it was deferred comp, and it's sourced to the United States because of that reason. So you need to make sure that you understand all that. Deferred compensation items that would otherwise not be taken into account under the Rule A Section 83 will be treated as becoming transferable and not subject to a substantial risk of forfeiture on the day of the expiration expatriation date. Sorry. Section 83 is basically, I call it the gambler's rule. Basically, what it says is that you can elect to do tax today on deferred compensation in exchange that when you do get your compensation later on, if there's any additional gains, they're all at capital gains rates. We call it the gambler's rule because if anything happens to you and you have to forfeit that deferred compensation package, the IRS isn't going to give you your money back that you've already paid taxes on. Okay, so we call it the gambler's rule. We tend to, I do recommend these for clients a lot, but it's because they're getting deferred compensation from big name companies. IBM Corporation is just an example. I don't have any clients that work there, but say for example you're working for IBM, they're going to give you deferred compensation of $300,000 after you work for them for 7 years. And you basically say, look, it's all based on stock price. I'll take the hit now. In exchange, when I get this money later on, if there's any growth that's taking place, it's all capital gains instead of at ordinary income. So it can actually save you thousands of dollars if you actually do it right. But again, that bleeds over into another topic that we don't want to talk about, except for in a separate video. Look, again, the purpose of this video is not to give you the answers, but more or less to have you ask the right questions when you're talking to your CPA or EA or your tax attorney and your tax professional. Again, my name is Kevin Matthews. I am the tax professor. Class is still in session because the learning never stops. If you have any questions for me, go ahead and leave a comment in the comment box below. Or you can reach out to me at my website. That's www.betasolutioncpa.com. www.betasolutioncpa.com, and we'll be very happy to reach out to you and answer your individual question. Thank you very much.